We had a better week in the markets as we note a lot of green across many industries, but the S&P is still down nearly 4% year to date, and some of the worst hit companies are the Mag 7 down double digits. In fact, every single one other than Microsoft is down significantly, and therefore there should be no surprises that investor sentiment is at rock bottom, sitting in extreme fear. But this could also be an opportunity to consider companies that we believe to be attractive at some good valuations, and that is the purpose of today's episode. We're looking at 2 must-buy stocks as well as 2 stocks that we believe are the best time to sell. And why we like to focus on this in the episode is because the S&P over the last 20 years, in fact from 2001 to 2020, was up 7.5% year on year, but when we compare that to the average investor, they have massively underperformed, up only 2.9%, and therefore we need to understand, 1, when is the best time to buy a stock, and 2, in fact more importantly, when is the right time to sell. Now, if you're someone that likes to follow along with analyst Tom Lee, someone that's actually quite popular and on CNBC quite regularly, he believes the sell-off we have seen over the last few weeks is a massive overreaction, and he believes now could be a great time to buy. In fact, he goes on to say that the odds of the 10 best days coming are very soon into April, May and June, and the markets as a whole are so oversold and pessimistic that a sizable rally is right around the corner. And just in this month, we also noticed the S&P's first 10% correction, and that is something we haven't seen since 2023, and it's also something that is very normal. For example, a correction is noted on a historical basis at least once every year. A severe correction, now that is 15% or more, is once every 2 years, and a bear market, not something we are in just yet, is 20% or more of a drop, noted once in every 3 years. Now, these are all opportunities to buy quality companies at some incredibly attractive prices, and if we look at the market, we can see a bit of rotation where tech stocks have lagged other areas. In fact, healthcare, one of the best in the markets in 2025, are up 4.3%, a massive outperformance, and that is why today we want to highlight the companies we believe now are showing incredible opportunity. And the first one is Meta Platforms. Now, Wall Street gives this company a strong buy. Seeking Alpha consider this a buy, and it's pulled back quite some way away where we believed it wasn't a good stock to hold at $741. Now it's trading in the midpoint where we see a lot of opportunity. It does pay a dividend around 0.35%. The valuation, as we will come to show you, does look very attractive, and over the last year it's up 17%. Over the last 5 years and over the last 10 years, where it's up 616%, on all occasions have massively outperformed the S&P. And just in their latest quarter, we see their revenue up strong double digit, 21% year on year, but it doesn't stop there. We're seeing efficiencies in their gross margin up 1 percentage point, their operating profit up 7 percentage points, and their bottom line up 8. So not just increasing revenue, but also their margins. Remember, that is a key identifier for a high quality company, and they expect 3 of the next 4 quarters to be growth to the earnings per share, whilst having a 100% track record over the last 4 quarters, 4 out of 4 beats, the most recent one very sizable, and based on December 2025 earnings per share, the forward valuation of the company sits at around 23.5. And why we're starting to like this company, we see a lot of activity in the Meta family. Now, this is classified as the apps under their umbrella. We have Facebook, Instagram, WhatsApp, as well as Messenger, and year on year, quarter on quarter, this number is only increasing, getting higher and higher. And what this then translates to is average revenue per person on their platforms only increasing. In fact, quarter 1 in 2022, this was at $9.57, and just over the last few years, we're seeing around a 50% increase to the value that each customer is giving to the company, and we don't anticipate this to stop anytime soon. Now, one area that we like to look at companies in terms of valuation is comparing their forward P to their historicals. Right now, trading around the 23 region, that isn't that far off their own 5-year, so just based solely on this model, you could argue reasonable valuation. And then when we look at another model where we have the blue tunnel signaling the expected fair price, we notice right now sitting in the middle, again another reasonable signal, but bear in mind we're not concluding on any of these valuations. We're going to run it through our own discounted cash flow shortly, but we like the fact that over time the blue tunnel is increasing, meaning the expected price of the company is only getting higher and higher, something we need from companies we're considering to invest in. Now, their valuation grade, they do get an F. Main reason for this is because the sector does trade significantly lower, so you are paying an 86% premium, one that we will go on to show you we believe they deserve. In terms of their 5-year, we pretty much just covered this. It is in line, and if you do look at other valuation metrics, again, we do believe they deserve it, but they are trading at quite a significant premium, and they're not that far off their own 5-year averages. So why do they deserve it? The growth comes in at a C, but year on year, revenue is up 22%, sector low single digit at 2. They're even growing faster than they have done over the last 5 years. Over the next 12 months, expected 17%, again well above the sector at 3%. Their 5-year average coming in not too far off at the 17 point, but earnings per share over the next 3 to 5 years expected to grow 17% year on year, well above the sector at 12. Again, this is why we are seeing a premium demanded, and their own 5-year average pretty much coming in line at 17.5%. Profitability, very strong A+. Remember, we just showed you efficiencies from their latest quarter. 82% gross margin, well above the sector at 52, above their own 5-year at 80.7. Bottom line, 38%, well above the sector at 3.6, above their own 5-year of 30%, not only growing their revenue faster than they have done over the last 5 years, but they're also increasing their margins, such a strong combo for any company you want to consider. Cash from operations, 91 billion, nearly twice as much as they've generated over the last 5 years at 56, and well above the sector, which is looking very low in comparison at 362 million. We also just want to highlight in a graphical format that they have massively outperformed the S&P over the last 10 years, returning 620%, whilst the S&P in the same time frame 175, and this is a very good sign, although bear in mind, past performance is not an indicator of how they'll perform in the future. We also want to flag what super investors are doing with their portfolio in terms of the companies we're running through today. Now, whilst we do note Meta Platforms here sitting in 6th position, if we do remove the duplication of Google due to the 2 different share classes, it is the 5th most held stock where 22 investors do hold the company, and that does maybe give you some faith that it is a high quality company, but as always we need to do our own due diligence. And if we look at institutions where they hold 80% ownership, they sold around 47 billion worth of shares over the last year, but they bought nearly twice as much, something we also note in the most recent quarter. So institutions clearly very bullish on Meta Platforms. They've been buying a lot more shares than they have in fact been selling. Now, our intrinsic value today for Meta Platforms comes to $700 derived from the DCF model. Now, we'll show you how we got to that figure. We have the free cash flow year on year, that included for their most recent year at 54 billion, average growth 34% year on year. We've gone incredibly conservative at 10%. As you can see, it is the lower rate from low at 10, medium at 12, high at 14. With a discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, $700, which in turn indicates 17% upside. Now, you can always grab a copy of this model as these numbers are subjective. Running through your own numbers or your own company doesn't have to be Meta by clicking on the pinned comment below. Now, we'll also show you for full transparency at the 12% rate, $805 indicating 35% upside, and at 14% we can see $925 indicating 55%. But as we mentioned at the beginning, we want to be more conservative for Meta Platforms at the 10% rate, where we're not done just there because we always apply a 10% margin of safety. Execute on that if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that in today's episode, a buy at $630, then we keep going till it's near the current trading price. And what we're effectively saying is around $595, where this company sits near to, you're getting a 15% MOS, high quality company, super investors love the company, institutions love the company, and Wall Street also give it a strong buy. But as always, do your own due diligence, with Wall Street noting a $764 price target over the next year, which in turn translates to 28%. As always, give us your thoughts about these companies, whether you believe they're a buy, hold, or sell. Now, we also want to let you know we have released our latest free weekly article where we drop one every single Monday morning completely free to your inbox, where we cover severely undervalued stocks as as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside right now in the S&P. So click below, you can sign up and read straight away. The next must-buy stock we have here is Alphabet, which is up 11% over the last year. Now it has been hammered down 14% year to date, but over the last 10 years, massive outperformance of the S&P, up 488, trading near its 52-week low with a double buy from both Seeking Alpha and Wall Street, and they pay a yield a little bit higher than Meta at 0.5%, whilst also trading at a severely low forward P in the 18 region. Now their latest quarter, we also note revenue up double-digit 12%. That includes the search advertising, which many analysts do believe is now dying, and we also see efficiencies like we noted in Meta in their gross, operating and bottom line. So very important when you're looking at high quality companies, these are things you need to consider. Whilst not every company can improve their margins and their revenue, this is what makes some of these companies a standout. Unlike Meta, they do anticipate the next 4 quarters all to bring growth to the earnings per share with a 100% track record, and as we just said, based on the EPS, they're trading at a forward valuation of 18.3, and something we covered a few days ago, they did just announce their biggest acquisition ever of Wiz Security, costing them around $32 billion, which in turn they believe will help their top line revenue and their cloud income stream. Now something we didn't touch upon, Google Cloud is their fastest increasing stream, up 30% year on year, and if we just take a look, whilst it has started to slow down a little bit, it is still very impressive. In fact, all of 2024 we're seeing growth at the high 20s, low 30s, which when you compare this to AWS, which is the market leader, they haven't increased as much in 2024. In fact, in comparison, Google Cloud is growing much faster. We notice AWS in the high teens, which does give them a lot of scope for growth, currently around 12% of global market share, and with that acquisition they are hoping to become the number one over the longer term. And as we can see, Google Cloud just increasing year after year after year, quarter on quarter, as well as turning profitable in Q1 2023. Now one thing they have come under fire for is effectively too much capital expenditures, where they anticipate for FY25 to sit around the 75 billion region. This is one reason, in fact, why the share price did get hammered after their earnings. Analysts were hoping for a significantly lower number in the mid 50s. Now as we've looked at with Meta, where it sat in line, Alphabet's valuation is at 18, below their 5-year average of 22. This gives us a severe undervaluation signal, and when we do take a look at this valuation model, it's actually showing some disparity between where it sits and the bottom end of the blue tunnel. Again, severe undervaluation. Now they also get a very poor valuation grade of F, where they trade above the sector, in fact 44%, as we've just highlighted, trading at a discount of around 28% to their own 5-year, and something again that is reflective across all of the valuation metrics. Alphabet trading at a premium to the sector, but a discount to their own 5-year numbers. Growth, however, showing they do deserve that essential premium. At a B, revenue growing 14% year on year, 12% moving forwards, well above the sector again at the low single digit, but a little bit lower than their own 5-year in the mid to upper teens. And we can also see expected EPS growth 16%, that is well above the sector at 12, but slightly below their own 5-year of 17.9. Profitability again very strong at an A+. Gross margin 58%, above the sector at 52, above their own 5-year of 56, efficiency is noted. Bottom line 29%, well above the sector at 4, above their own 5-year of 24%. Again, as time is progressing, their margins are only getting stronger and stronger, whilst also increasing the cash they generate from operations, 125 billion, well above their own 5-year of 88 billion, and significantly above the sector at 361 million. And as we can highlight here, over the last 10 years, up 491%, with the S&P a lot lower at 175. We also notice it is the second most held stock by super investors, and institutions with their 40% ownership have been selling 48 billion, but have been buying nearly twice as much. Again, something we note in Q4, and very similar to Meta Platforms, institutions clearly bullish on the company. Now, intrinsic value today at $226 is derived from the median rate, as we can see, indicating upside of 38%, but even if you use the lower end of 10%, it is still showing upside, price target 197. Now we'll take the medium rate, but we'll also show you what comes out in terms of the low rate for margin of safety. If you believe they can grow their free cash flows at 12% year on year, then you are getting a margin of safety of 10% up to 203, but actually quite a significant margin of safety in today's episode. Not at 30% just yet, but you're getting at least 25% up to $170. Wall Street, with their price target, $220, they see 34% over the next year. And we can show you, even if you believe the growth rate is going to be lower, around 10%, you are still getting a nice margin of safety. In fact, around 15% up to $167. Wall Street's price remains unchanged at $220, 34% upside. And also give us your thoughts if you believe these two stocks are very strong buys. We then move into the first stock to sell, which is Apple. Now this is one that's up 27% over the last year. Year to date, it's down 13%, but similar to the previous two, massive outperformance of the S&P, is trading in the midpoint of the 52-week range, a bit of a pullback from all-time highs of $260, and only one buy rating noted with Wall Street, and we can also see a yield not too dissimilar from Alphabet at 0.46%. Now their most recent earnings, quite disappointing at 4% year on year. That's pretty much just keeping it up in line with inflation, and iPhone sales were down around 1%, with the standouts being the Mac and the iPad up 16 and 15% respectively, and we do also note some efficiencies on all the margins, around 1 percentage point. Now they also expect growth to their earnings over the next 4 quarters, 100% track record, and as of today they are trading at a forward valuation just below 30, which as we can see is slightly above their 5-year average, indicating possible overvaluation. But if we were to look at this model, it's sitting pretty much in the middle to the upper end, so again you could argue a reasonable signal too, and probably no surprises that they do get an F. Essentially the sector trading at 22, so you are paying a 36% premium, and they're trading slightly around 5% higher than they have done over the last 5 years. So if you do look at all of the valuation metrics, they're telling you the exact same thing. It's trading at both a premium to the sector, but also a premium to what they have been trading for over the last 5 years. Is it worth the premium? Well, look, growth is at a D. Year on year, 3%, forward looking 5%, not too dissimilar from the sector, which actually sits a little bit higher. And over the last 5 years, they've actually grown their revenue a little bit higher, with EPS expected to be 11%. That is lower than the sector at 14% and lower than their own 5-year 11%. So they're trading at quite a significant premium whilst growing at a slower rate than the sector, and in fact expected to have earnings per share grow at a slower rate too. Now their profitability does look good at an A+, gross margin 47%, although sector actually higher at 51%, their own 5-year lower at 43%, so some efficiencies noted to their gross margin. Bottom line, 24%, above the sector at 4%, pretty much in line with their historical figures, and the cash they generate from operations at $108 billion isn't too dissimilar to the last 5 years at $105, but again a standout from the sector at $109 million. And we can also show you the massive outperformance they've had over the last 10 years, but always important to understand that past performance is not an indication of how they'll perform in the future. Now, similar to the previous two, we want to show you this is also one that super investors do hold. It's around the 10th most held stock, so clearly they do like it. But one thing we would say, if you're someone that likes to track Warren Buffett and what he does, whilst he didn't make any movements to Apple stock in the most recent quarter, we can see he has been selling over the previous 4. In Q3, we noticed around 25% reduction to his total portfolio. When we take a look at Q2, we can in fact see a large chunk around 50%. And in Q1 24, we do also note the continuation of the sales, something we also see as far back as Q4, although that was the smaller point at only 1%. Institutions, however, still bullish with their 68% ownership, 144 billion worth of sales, 210 billion worth of buys, and the same to be said, twice as much buying as they did sell in Q4 2024. Now our valuation comes around $200 in the episode today, where our growth rate, we've actually used 8% given what we have noted in their earnings as well as over the last few years. Now this in turn gives an intrinsic price of $200, and that means downside of 8%, so you are getting no margin of safety, with Wall Street seeing this at $250 over the next year, translating to 15% upside, the lowest of the 3 we have gone through today. We'll also show you, for those that believe we're being a bit too harsh, that maybe 10% is the better rate to use or the more accurate, that comes to $231, where a margin of safety at 10% would mean a buy at 208, so you're not even getting that right now. At 5% is where we see this. If you are someone that believes they will be able to turn things around, 10% is more appropriate, and for those that believe 12% is the most appropriate rate, you will clearly get a margin of safety, and as we come to show you, not at 20%, at least 15%, around 226. But as always, give us your thoughts whether you believe this is an appropriate one to consider to sell, with the lack of growth being one of the key drivers, as well as other better opportunities for your own money elsewhere. We then move on to the next stock to sell, which is Palantir, up 272% over the last year. Year to date, up 20%, and it's trading at the upper end of the 52-week range. A bit of a pullback from all-time highs at $126. Triple hold right across the board, and trading at a valuation which everyone knows does look a bit ludicrous at $163. Now, their most recent quarter was very impressive, up 36%. However, we actually noticed some deficiencies to their margin, both gross, operating, as well as bottom line, all lower than the same quarter last year, but they are anticipating double-digit growth to the EPS over the next year of 2025, whilst having a 100% track record, and as we just said, forward valuation in the 163 region. No surprise then they do get an F. If we look at the sector at 22, you are paying a 645% premium, and if we look at where they've been trading over the last 5 years, you could argue this is a company that continues to trade at a high valuation. You are still now paying around 31% more than you would have done on average over the last 5, and something super consistent across every single valuation metric. If we would take a look at their growth at an A- year on year and over the next 12 months, expected 29%, well above the sector in the mid-single digit. Is it worth that much of a premium though? Again, questions to consider, and we notice they've been pretty much in line with what they've grown the revenue over the last 5 years, with the expectation of EPS to grow at 26%, well above the sector at 14%, but quite some way below their own historicals of 46%. So earnings per share expected to grow quite some way below, but the company is trading at a much more premium valuation than what we've noted over the last 5. Profitability comes in at an A. Now, gross margin 80%, above the sector at 50%, but also above their own 5-year of 76%, so some efficiencies noted. 16% in terms of the bottom line, well above the sector at 4%, well above their own 5-year where they've been losing money, negative 34%, and we can see cash from operations just over $1 billion, significantly higher than their own 5-year at $311 million, but also well above the sector comparative at $109 million. And we can also show you over the last 3 years, massive outperformance of the S&P, where it has been in fact up 622%, S&P in comparison 27%, and just for consistency, we want to show that there are no super investors that currently hold this in their portfolios, but in terms of insider sales, well, firstly, no insider buying, but we've noted over the last 12 months, $3.7 billion worth of insider selling. Now, bear in mind, whilst we do say that, and it is a significant amount, we don't typically see this as a bearish signal. Insiders sell for many reasons, both personal and financial. Institutions, their ownership 46%, $7 billion worth of sales, $13 billion worth of buys, so around 50% more buyers than sells. And we also notice the same thing to be said in Q4. Institutions, though, clearly more bullish than they are bearish. Now, our valuation, we have got $88 here, but this is just something to understand. This is if their growth rate is 35% continual over the longer term, something that perhaps a lot of people don't believe to be realistic. If we were to take a look at this, we would perhaps go for the 30% rate, which in turn would give this a valuation of $65. Again, investors may believe 35% is more appropriate, given just over the last few years, they have been growing at a very fast rate, and there'll be others that believe perhaps 40% is most accurate. And what this effectively tells us, unless they're expected to grow above 35%, then this company has current downside. Now, we'll take through the median rate today for 35%, but as we said, if we really had to look at it, we would use the lower end of 30, meaning a value of $65. If you are someone though that believes 35% to be more accurate, it isn't that far off, so you could argue reasonable signal, but in terms of a margin of safety, if you believe that at 10%, you'd have to wait for $79, at 20% around 70, and at 30 around 62. Again, we can show you for those that believe, like us, 30%, perhaps even looking quite high, is more reasonable than the other two. A 10% margin of safety would be a buy at $58, at 20% around 52, and at 30% around 45. Now, we also have an exercise here for those that believe over the longer term it can be a $1 trillion company, and now we put the price of Palantir at $380. Now, Wall Street themselves don't see too much upside, hence why we got the hold rating where they see this at $94 over the next year. That is only 3%, and hence why we do put it in the sell category. As always though, give us your thoughts below whether you agree with these 2 must buy and 2 sells. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we do cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.